CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund.
Hello and welcome to CNBC TV 18's Women and Money series presents Financial Quotient, powered by For Her, an investor education and awareness initiative by Aditya Birla Sun Life Mutual Fund. I'm Sumera Abdi. Today, we'll be talking about how to identify short-term and long-term financial goals and the key factors to keep in mind when you're trying to build a strong financial plan. So joining me to help you plot out this easy roadmap to develop a financial plan is Dilshad Billkmoria, who's the Managing Director at Dilzer Consultants. Dilshad, thanks very much for joining us in this campaign. And, a solid financial plan is really the first step, right, in ensuring a successful financial future. So what are the building blocks? What are the key factors to keep in mind when somebody is trying to start off to make their financial plan?
Yeah, I think the journey starts with typically understanding one's needs, one's goals, one's objectives, and the must-haves and the priority goals, right? So, for example, something that we do for all clients as a must-have is like an emergency fund. Whether the client asks for it or not, we create an emergency fund, especially after what has happened in the recent past with COVID. We also try and segregate the priorities of clients as per their goals. So whether it's short-term, medium-term, long-term goals, we try and involve them in matching their resources with their goals. Another thing that we try and give a lot of importance to is health insurance and life insurance. Sometimes both these are underrated, and people don't realize the importance of inflation on both these costs. So I think a kind of understanding and learning for our clients is only going to help them in the long term in this regard.
Okay, Dilshad, if we analyze some of the portfolios of people who have, say, been investing for, even 5-7 years, perhaps 10-15 years, the one thing that strikes me, very often is that there is no cohesive plan. As people go along, as their salaries increase or as they have, more money to spare, they are just ad hoc buying products, right? There is no comprehensive solution or no comprehensive stitching of all of this together. So what is the checklist that people must, or investors, especially women, must prepare of, when they're getting started, and when, say, every time they have money to add on, what are the factors they must consider before they actually invest?
Yeah, that's a very good point, Smera, because especially with the younger generation, the goals seem to be changing on a real-time basis. And many of the goals seem to be more towards experiential rather than long-term. So, they don't consider priority sometime for retirement, or they don't understand that they need to plan for their, kind of a nest egg, or if they are, planning to have children, have a sabbatical fund in place. So I think these are important discussions that an advisor needs to have with their client initially. And another importance is the goal review. Now, this is where we do an annual strict check on one's entire resources. So what would be their financial assets? What would be the non-financial assets? What is their asset allocation? Where do they stand in terms of their portfolio? Where are their policies? So a thorough check is done. And this is a very important kind of meeting or a discussion, because it's also a cleanup of things that are not unwarranted, or something that is not performing well, or something that does not match the time horizon, the goal, right? So somebody cannot invest in equity for a period of, say, 2 years or 3 years. Although the markets have done well, they need to realize the importance of, what each instrument or product is taken for, what is the recommended time horizon of holding for each of these products and investments.
Dilshad, one of the other things that actually is quite intriguing is, when a lot of times people may not have, exact goals. They may just say my objective is to maximize wealth. The times that people actually state their goals, they may have a very inflated amount of money associated with that goal. That I need to buy a house over the next 3 years. I need to accumulate, say, whatever, 50 lakhs, but I'm investing only a few thousand rupees. So how can people sort of align their time horizon to their goals, which is a realistic way to do this, and therefore, not jeopardize your investing journey?
Investment management is not really a rocket science, right? So you cannot say that, I have only this much of resources, but at the same time, I want to travel to Europe, and I want to buy a yacht, and I want to do this, and I want to, experience the best of holidays, etc. So we tell them upfront, right, when it comes to matching their resources with the kind of goals that they have. So that is the first step of understanding where they are. So that is the entire purpose of the financial plan. Secondly, we'd say that there are certain investment options and solutions that match certain time horizons and match certain requirements. And then we try and build first what they already have and try and ensure that, is there for example, if somebody is a salaried person and is already earning an employee provident fund benefit from their employer, very often, because they have met us so early, the EPF monies are good enough to meet their retirement corpus, right? So we don't need to do so much more. And something like EPF is so sacrosanct because we tell them that, look, under no circumstance can you withdraw this money. Under no circumstance can you use this for any other objective or goal that may come in between. Say you want to buy a property, or you want to buy a real estate kind of asset, or you want to go for a short tour, or whatever it may be. Under no circumstance can you use these monies for that, except for retirement. So I think that education and that understanding becomes very important in the entire exercise of financial planning.
And when we're talking about this whole differentiation between short-term goals and long-term goals, the other thing is that there may be more than one short-term goal, and there may certainly be more than one long-term goal. So how do you, one, identify all of these, and secondly, when you're investing, do you sort of invest en masse? That I'm going to be investing, just as a case study, say 40,000 rupees a month. Do I still invest in just, say, 6 or 7 funds, and I just allocate that, for my short-term goal, I needed an X amount of money. For long-term goal, I need Y amount of money, and I will therefore withdraw it from this kitty? Or do you have separate portfolios for each of your goals?
Yes. So again, this is very interesting because here we first understand what are their goals. Then we segregate them into short, medium, and long term. Then we also ask them, look, what is your priority? Okay, because like I said, sometimes the resources and the gold corpuses do not match. So we ask them, what is your priority? And then say somebody comes with, like you said, 40,000 or 50,000 or a lakh or whatever is the amount. We say that we are going to be investing this, number one, as per your priority of what you have said is important for you. And number two, we're going to be also investing as per your risk profile, right? So asset allocation, asset selection is the basis of any financial planning or investment management exercise. So we cannot just arbitrarily suggest, okay, if somebody is coming with an SIP, should we put everything into equity? Should we put in different asset classes? It's very important to get that part right initially, because that is what is going to help the investor when the markets fall. So I think the asset allocation piece is one of the most critical parts of the planning exercise as well.
Dilshad, do you think most investors are able to adequately assess their own risk appetite, or do they need professional help in that aspect?
Oh, yes, absolutely. They need professional help. We have come across some, do-it-yourself investors, or some people that they think they know it all, especially the younger people. I would, give them an advice saying, you start with whatever you feel or you think might be the right way of doing it. And very often they come back and say, we did this wrong. Or take, for example, last year when the markets kept going up, they started investing more, which is not the right way of investing. So you definitely need a professional guide, to help you understand where you are, where you want to go, and even monitor and review that. And more often than not, it's more like a sounding board. I mean, people cannot say that I'm going to take charge of this or I'm going to take charge of my risk profiling and it's very simple and it's very straightforward. No, there is a science to it as well. And you do need a professional, a certified financial planner to help you in that.
How should asset allocation be done? I mean, since, any number of experts will tell us that that is the key to actually ensuring that you succeed, with your plan. What is is it a top-down approach? Should people look at, asset classes first, then look at products within products? There is any number of choices now available. So how do investors make that distinction?
So asset allocation is an outcome of one's risk profile. And by asset allocation, I mean broadly defining the asset classes, right? So it's not just equity, debt, cash. It could be, non-financial assets. It could be REITs. It could be gold. It could be international equity, right? So there are so many other assets. It could be ETFs. So what we do is first draw the broad plan of what should be the base asset allocation, which is the resultant of one's risk profile. Uh, After that, we try and delve into each of these asset classes and try and suggest investment products that are negatively correlated. The more negative correlation that there is in an asset class or even within the entire asset allocation exercise, the better it is for the investor, because that's when the diversification game really plays out. And there is no one asset class, as you know, would do well at any point in time. So this is like a cushion. When things fall, you are ensuring that you're protecting your overall portfolio with the downside risk and volatility.
Can I ask you to just explain this negative correlation a little bit more, maybe, perhaps with an example so that everybody understands it, because, this is really one of the cornerstones of a good financial plan.
Right. So, negative correlation means investing in an asset class which are not moving in the same direction. For example, equity. If the economy is doing well, equity would do well. And if, for example, interest rates go up initially, the existing debt funds would fall. So these are very dependent on certain factors. I would say micro as well as macro factors, which impact the performance of portfolios. But if you dig deeper, you need to understand what exactly makes up the risk return profile of an asset class or a product. And that's when you start analyzing those investment products which are a hedge against any of these changes that happen so often. So, for example, if you say that, for example, gold, right? So, gold is a hedge against, say, a falling equity market, or international equity investing is an added investment asset class that we would add because it is geographically diversified compared to the Indian economy, right? So this is where we try and understand where the impact of these products would be when it comes to various scenarios, micro, macro, economic, geographical. So these are the decisions that we have to take. So the baseline is to select those products or asset classes that don't move in tandem and don't move in the same direction if economy is growing or falling. So that is the idea of negative correlation in asset selection.
Dilshad, thank you so much for joining in today and explaining some of these, basics, like a starter pack really for getting started, and how to define short-term investments and long-term investments, and more importantly, the fact that every investor who's starting out must have a plan. So if you're already investing and you don't have a plan, you want to get down and make a plan and sort of course correct right away. The earlier you do it, the better it will be. So thank you very much for watching. I hope you found this helpful.
CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.